same time.
Fair enough. But mainly you bought it for the protection, right? For example, your car insurance, you buy it in case you get into a car accident. Or fire insurance, you buy it in case your house burns down. Would it be fair to say you mainly bought life insurance in case you die?
Yeah, I guess you're right.
Cool. How much coverage do you currently have?
About $300,000 each.
And how much are you paying every month?
About $250 per month.
Also, how exactly did you get a hold of this policy? Was it a friend that sold it to you?
No, I bought it online through a website.
Okay. And when was the last time you saw the agent that sold you the policy?
I never met them. We just spoke over the phone.
I get it. No problem. It's probably fair to say you've never seen insurance explained like this before, so let me break it down for you. Taking away all the fancy marketing from the equation, life insurance is broken down into three types. The first one is called term insurance. This is the most basic and simplest form of life insurance. Just as the name suggests, you buy life insurance for a specific term. You can buy a 10-year term, 15, 20, 25, 30, and even a 35-year term. This example will make more sense. Let's say you buy a $500,000, 30-year term policy for $100 per month. This means is your coverage and payments will not change in 30 years, regardless of your health and lifestyle. However, after the 30 years is up, you'd have to pay more to keep the same coverage, or you'd have to change the plan to make it more affordable. Does this make sense?
Yeah, it does.
There's a good and bad to all life insurance policies. For term insurance, the good thing is it's really cheap. The bad news is it eventually renews and will cost you a lot to continue it. The second type of insurance is whole life insurance and is a form of permanent insurance, meaning there's no end date. Once the policy is set and you continue to make the payments on time, the policy doesn't change. You have it for your entire life, which is a good thing, but the trade-off is the price. For the same $100 a month payments, you can get roughly $200,000 of coverage. The reason it's more expensive is because sooner or later, the insurance company is going to have to pay you $200,000. It makes sense they're going to charge you more, right?
Yes, I never saw it that way before.
Here's how it works. Whole life insurance bundles both life insurance and savings together in one payment. For example, out of the $100 you pay, $40 goes to the insurance part, and $60 goes to your savings. Looks simple enough, however, there's four bad things about this kind of policy. 1. There's no savings for the first 2 to 4 years of opening the policy. You're making the payments, but the savings will remain $0. 2. Once you start to accumulate savings, the returns are fairly poor, around 1 to 3% per year. 3. If at any time you want to take some money out of the savings, the insurance company will charge you a loan of 6 to 9% to borrow your own money. 4. If you die, they'll pay the $200,000 to your beneficiary, but they'll keep everything that's inside the savings. Or, if you take out all the money from the savings, they cancel your policy. So essentially, you're buying two things, but you only get one or the other, never both. Like I said before, all insurance has good and bad sides. With whole life insurance, the good is you're covered for your entire life, but the bad is it costs a lot to get enough coverage, and the rules can be tricky to understand. The third type of insurance is called universal life. It's a mix of term and whole life insurance. The insurance part is based on something called annual renewable term. This means the insurance cost goes up each year. Let's say you pay $100 a month for $200,000 coverage. When you're young, the insurance is cheap, maybe just $10 a month, leaving $90 for savings. But as you get older, the insurance cost goes up. In 10 years, it might be $50, so only $50 goes into savings. In 20 years, the insurance could be $120, but you're still paying $100. Where does the extra $20 come from? They take it from your savings. The longer you have the policy, the more they take until your savings run out. Then what happens? You lose your insurance. Like other policies, Universal Life has good and bad sides. The good, you can choose your payments. The bad, it's expensive, has lots of confusing rules, and if you're not careful, it can hurt your finances. Now that you've seen how each policy works, let me ask a question. If you were to purchase insurance to protect what's most important for you, which one of the three protects you the best?
Well, that's obvious term insurance does.
Let's flip the question around. If you were the agent and you were to get paid $1,200 for selling the term policy, $2,400 for the whole life policy, or $3,600 for the universal life policy, which one would you be most tempted to sell your client?
I guess the universal life policy.
Exactly. Do you see where there's a conflict of interest here? That's why almost 80% of the people we sit with who have insurance has either whole life or universal life insurance. Term insurance is cheap and covers a lot, but it can get pricey as you get older. However, there's a trick to deal with that. Think about it. You mostly need life insurance when you're young. That's when you have kids, a big mortgage because you just bought a house, and not much savings because you're starting out. But as time goes on, you save more. By the time you're close to retiring, your kids are probably grown, your mortgage is paid off, and you've saved a bunch. Maybe $1.5 million in total if you add up all your assets like your personal savings, your home value, and work pension plans. So, do you still need life insurance at that point in your life?
Probably not.
But if you want it just in case, how much could $1.5 million get you? A lot, right? So basically, you've become self-insured. That's way better than hoping your spouse dies to be financially secure, don't you think? Let me show you a two-step plan how you can implement this without breaking your budget. It's called buy term and invest the difference. First thing we need to do is figure out exactly how much insurance you need. A quick way of doing this is through this simple exercise called DIME. If something were to happen to you, would you want to ensure your kids' education is paid for?
Yes, of course.
You have 2 kids. The recommended amount is $25,000 per child. So in total, you need $50,000 of coverage. What about final expenses? Do you want to cover that as well?
Yes.
The average funeral expense is roughly $25,000 each. What about your mortgage? Do you want that paid off?
Yes, of course.
How much is left on your mortgage? Just an approximate amount is okay.
Roughly 500,000.
I'm assuming you'd want to leave some money behind in the form of a survivor income as well. If you were to leave $5,000 per month for the next 10 years to cover bills and expenses, that comes up to $600,000 of coverage. And last thing is debts. Roughly, how much do you have in debts?
About 30,000?
Okay, if we add this all up, it comes up to $1.2 million each. At the moment, you're paying $250 per month for $300,000 of coverage each. How old are you?
Right now, I'm 35 years old.
How about your spouse?
She's the same age.
Do you guys smoke?
No, we don't.
Here are 3 different options. The first option is the cost to fully cover the home at the longest term. If you qualify for a $1.2 million policy each for 30 years, it would cost you $274 per month total for both. That's 4 times more coverage for just an extra $24 each month. The second option provides slightly reduced coverage at a shorter term. For $1 million each on a 20-year term, it would be $131 per month. You'd save $119 every month for more than 3 times the coverage. The third option provides a straight replacement as is. If we switch your $300,000 coverage each, you'd only pay $58 per month, saving you $192 per month. What would you do with the savings?
I'd probably invest the money.
That's right. If you invested $119 per month for 20 years at an 8% return, you'd have an extra $70,561. If you went with the third option, you'd have $113,846. With this plan, your family is secure whether you pass away too early or live a long life. Even after the term ends, if you want to keep the insurance, you can do that with $113,000 in your savings. You get the benefits without spending extra money. Out of these 3 options, which one makes the most sense for you?
Probably the second option would make the most sense.
As much as I'd like to give you this option, insurance isn't something you just buy. It's something you have to qualify for. If you did qualify for option 2, would you keep it?
Yeah, of course I would.
Great. So here's what happens next. We submit an application along with 1 payment. This will start the underwriting process, and in about 2 to 3 weeks, we'll get a response back whether you've been approved or not. If you're approved, we've already collected 1 payment. If it comes back declined, we simply return the payment back to you. Does this make sense?